Here's what nobody's telling you about this Friday's Social Security payment. And it's costing people real money because they don't understand the timing. February 1st falls on a Sunday this year, which means if you're collecting supplemental security income, your check already hit your account 2 days early on January 30th. Now here's where it gets interesting. You won't see another SSI payment until February 27th. And that's actually your March payment coming early because March 1st also lands on a Sunday. So you've got folks calling the Social Security office thinking they missed a payment when the reality is the administration shifted the schedule to keep you from going without money on the weekend. But let me break down what really matters here. The 2.8% cost of living adjustment that kicked in this January for the average retiree pulling in about $215 a month. That's $56 extra dollars showing up in your account. Now, I know what you're thinking. $56 doesn't sound like much when you're watching your grocery bill climb and your prescription costs eat into your budget. And you're absolutely right to feel that way. But here's the math you need to understand. That increase is calculated using something called the Consumer Price Index for urban wage earners. And it doesn't track what you're actually spending money on. Healthcare, prescription drugs, the things that hit retirees hardest. So let's talk about what this really means when your money hits your account. Because timing is everything when you're on a fixed income. For those of you getting regular Social Security retirement benefits, your February payment is coming exactly when you expect it based on your birthday. If you were born between the 1st and 10th of any month, your check arrives Wednesday, February 11th. Born between the 11th and 20th, you're looking at Wednesday, February 18th. And if your birthday falls after the 20th of the month, you're getting paid on Wednesday, February 25th. Now here's something most people don't realize. This birthday-based payment system only started back in May of 1997. Before that, everybody got paid on the 3rd of the month. So if you started collecting benefits before May of 97, you're grandfathered into that old system, which means your payment still comes on the 3, or in February's case, Tuesday the 3rd, because that's the first business day after the weekend. Let me tell you something that drives me crazy about how people talk about this 2.888% increase. They make it sound like free money falling from the sky, but what they're not telling you is that your Medicare Part B premium just jumped from $185 a month to $22.90. That's an increase of almost $18 a month, which means right off the top, nearly a third of your cost of living adjustment is going straight to Medicare before you even see it. So that $56 raise the average person is getting, it's really more like $38 after Medicare takes its cut. And don't even get me started on the Part B deductible, which climbed from $257 to $283 for the year. This is the third consecutive year that Medicare premiums have increased faster than the Social Security cost of living adjustment. And that's a problem nobody in Washington wants to talk about. Now, I want you to understand something fundamental about how this whole system actually works, because knowledge is power when it comes to your retirement security. The cost of living adjustment isn't some arbitrary number that bureaucrats pull out of thin air. It's calculated using something called the Consumer Price Index for urban wage earners and clerical workers, which is a mouthful, so everybody just calls it the CPIW. The Bureau of Labor Statistics takes the third quarter numbers from last year, compares them to the third quarter numbers from this year, and whatever percentage increase they see becomes your COLA. The problem is that the CPIW measures what working-age urban employees are spending their money on, not what retirees are actually buying. You're spending a much bigger chunk of your budget on healthcare and prescription drugs than some 30-year-old office worker. But the formula doesn't account for that difference. There's been talk in Congress for years about switching to something called the CPIE, which stands for Consumer Price Index for the elderly, and that would weight healthcare costs more heavily. But every time it comes up for a vote, it gets shot down because it would cost the government more money. So you're stuck with a formula that doesn't really reflect your actual expenses. Let me break down what's happening with the maximum benefit amounts because this affects some of you, especially those who had high earnings throughout your career. If you're claiming at full retirement age in 2026 and you earned the maximum taxable amount every single year from age 22 onward, your monthly benefit would be $4,150. That's a solid number. But here's where the math gets interesting. If you claimed early at 62 instead of waiting until your full retirement age, that same benefit drops all the way down to $2,169 a month. You're leaving over $1,000 on the table every single month for the rest of your life. On the flip side, if you can afford to wait until age 70, that monthly check jumps to $5,181. That's the power of patience and delayed gratification, and it's exactly the kind of long-term thinking I've been preaching for decades. Most people can't wait that long because they need the money now, and I understand that. But if you're still working and you don't actually need Social Security to pay your bills, every month you delay past your full retirement age adds 0.23% to your benefit. That compounds to 8% per year. And you can't find that kind of guaranteed return anywhere else in today's market. Now let's talk about something that catches people off guard every single year, the earnings limit. If you're under full retirement age and you're still working while collecting Social Security, there's a cap on how much you can earn before the government starts withholding benefits. For 2026, that limit is $24,480. If you earn more than that, Social Security withholds $1 of benefits for every $2 you earn over the limit. So let's say you're earning $30,000 while collecting benefits and you're under full retirement age. You're $5,120 over the limit, which means Social Security is going to withhold $2,760 of your benefits. Now, here's what most people don't know. That money isn't lost forever. When you reach full retirement age, Social Security recalculates your benefit to give you credit for those withheld months. But in the meantime, it feels like a penalty for trying to earn extra income, and that frustrates a lot of people who thought they could supplement their benefits with part-time work. There's a different limit if you're going to reach full retirement age sometime during 2026. In that case, the earnings limit jumps all the way up to $65,160, and they only withhold $1 for every $3 over that limit. But this only applies during the months before you actually hit full retirement age. Once you reach that milestone, the earnings limit disappears completely, and you can make as much money as you want without any reduction in benefits. For those of you receiving supplemental security income, your situation is unique, and you need to pay extra close attention to the payment schedule because it's different from regular Social Security. The maximum federal SSI payment for an individual went up from $967 to $994, which is a $27 increase. For couples, the maximum jumped from $1,450 to $1,191, a $41 increase. Remember, Your February payment already came on January 30th, and your next payment won't arrive until February 27th, which is actually your March payment coming early. This happens because SSI is always supposed to be paid on the first of the month, but when that first falls on a weekend or holiday, they move it to the preceding business day. So you need to budget carefully for that longer gap between payments. I can't tell you how many people call in to radio shows confused about why they didn't get their February SSI payment in February, and it's because they already got it back in January. Mark your calendars and plan your expenses accordingly, because if you're living paycheck to paycheck, that timing matters enormously. Here's something that really gets under my skin about the whole Medicare premium situation. The standard Part B premium of $22.90 only applies if your income is below certain thresholds. If you're a single filer and your modified adjusted gross income was above $19,000 based on your tax return from 2 years ago, you're paying an income-related monthly adjustment amount on top of that base premium. These surcharges charges can be substantial. At the highest income level, you could be paying up to $689.90 a month for Part B coverage. That's more than triple what someone at the standard premium is paying, all because you had the audacity to be financially successful during your working years. Now, I'm not saying wealthy retirees shouldn't pay their fair share, but the way this system is structured creates some perverse incentives. People start doing financial gymnastics to keep their income just under those thresholds. Converting traditional IAS to Roth accounts years before retirement, timing capital gains carefully, all to avoid these surcharges charges. It turns retirement planning into a chess game against the IRS instead of a straightforward plan for living your golden years with dignity and security. Let me tell you about something called the hold harmless provision, because it's going to protect some of you, but not all of you, from the full brunt of that Medicare premium increase. This rule says that your Part B premium increase can't be so large that it actually reduces your net Social Security payment below what you received the previous year. So if you're getting a very small Social Security check and the full Medicare premium increase would eat up your entire COLA, and then the hold harmless provision caps your premium increase to match your COLA increase. The problem is this only applies if you're having your Medicare premiums deducted from your Social Security check and you were already enrolled in Medicare last year. New Medicare enrolls don't get this protection. People who pay their Medicare premiums directly instead of having them deducted don't get this protection. And people with high incomes who are paying those income-related adjustment amounts don't get this protection either. So it helps the most vulnerable seniors with the smallest checks, which is good, but it leaves millions of people fully exposed to these premium increases. I want to shift gears and talk about what happens when your Social Security payment doesn't show up on time, because this causes panic for people every single month. The Social Security Administration says you should wait 3 business days after your scheduled payment date before contacting them. 99% of payments arrive on time because everything's done electronically now through direct deposit. But things can still go wrong. Maybe your bank had a processing delay. Maybe there was an issue with your account information. Maybe the Social Security Administration made an error on their end. If 3 business days have passed and your money still hasn't shown up, the first call you make should be to your bank to confirm there's no issue on their side. If your bank says everything looks fine and they haven't received anything, then you need to call Social Security at 1-800-772-1213. They're available weekdays from 8 in the morning until 7 at night in your local time zone. Have your Social Security number ready. Be prepared to verify your identity and be patient because wait times can be long, especially right after payment dates when everybody who didn't get their check is calling at the same time. Now, let me give you some practical advice that could save you a lot of stress and confusion. Create a personal My Social Security account online if you haven't already done that. This is free, it's secure, and it gives you access to information you're going to need. You can see your payment history, verify your benefit amount, check when your next payment is scheduled, get your SSA 1099 form for tax purposes, and even request a replacement Social Security card without having to visit an office or mail in paperwork. Your COLA notice for 2026 is already available in the message center of your My Social Security account if you created that account by November 19th of last year. If you miss that deadline or you haven't set up online access, you'll get your COLA notice in the mail sometime in December. But why wait for the postal service when you can access this information immediately online? And here's a pro tip. Once you're in that My Social Security account, go into your message center preferences and opt in to receive notices electronically instead of by mail. You'll get an email or text alert when there's a new message. You can read it immediately and you don't have to worry about important documents getting lost in the mail or sitting in your mailbox where someone could steal them. Let me close this section by addressing the elephant in the room that everybody's thinking about but nobody wants to say out loud. Is Social Security going broke? Are your benefits safe? Here's the truth. The Social Security Trust Fund is projected to be depleted by 2033 or 2034, depending on which economist you ask. But, and this is a massive but, that doesn't mean benefits go to zero. Even if Congress does absolutely nothing and lets the trust fund run dry, Social Security would still be able to pay about 80% of scheduled benefits from ongoing payroll tax revenue. So your benefits would get cut by roughly 20%, which would be painful, but it's not the apocalypse scenario some people are imagining. The reality is that Congress will do something before we get to that point because seniors vote in huge numbers and no politician wants to be responsible for cutting Social Security benefits. They'll probably raise the payroll tax cap, maybe increase the retirement age for younger workers, possibly means test benefits for high earners, or some combination of all these approaches. The sooner they act, the less painful the fix will be. But this is Washington we're talking about. So they'll probably wait until the last possible minute and then pass something in a panic. In the meantime, you need to plan your retirement, assuming your benefits will be there, but potentially at a reduced level if you're younger. And you absolutely cannot rely on Social Security as your only source of retirement income. That's a recipe for disaster, no matter what happens with the trust fund.